Welcome to this MPE&VCA webinar. In this webinar, in contrast to many of the other webinars over the past few weeks, we promise not to use the word COVID and we promise not to talk about COVID. Instead, we want to look forward and address a topic of interest to us all, which is publicly listing a business on a stock exchange. But a few points before we start. MPE&VCA. Please check out our new website. We're very excited about that. A lot of work's gone into it. We've got a growing membership base with all the key players in the investment industry involved in Myanmar. And if you're not a member now, it's time for you to consider the advantages. Our mission is to increase awareness and to facilitate the growth of private equity and venture capital in Myanmar and of the financial services industry as a whole. We're currently small when we compare ourselves to our peers in Vietnam, in Indonesia, and India, but we're confident that over the next few years, there will be a significant growth and that all of us involved in this industry will benefit together with the overall economy in Myanmar. MPE&VCA's got an active month. This month, we've got a panel discussion on the 16th of July, which is part of our digital payment series, which is on the path to mass e-payment adoption for Myanmar telcos. And then we also have a seminar which is on warranty and indemnity insurance on July the 23rd. So take a look at the website, take a look at the events, please register. This webinar is being recorded, so if you've got any problem with that, you should not participate. The slides and the recording will be available to attendees, and Juliet and Kun, who are the people who do all the hard work for the association, will be available and able to help you with those presentations and recordings. Julia's presentation is going to take about 40 minutes, leaving us plenty of time for Q&A. Can you use the chat function to ask a question? After Julia's presentation, Juliet will moderate the questions, and this is a great opportunity for you to be able to ask questions on all sorts of practical issues. But why is this of interest to us all? Why is listing of interest? A listing on a stock exchange marks a sign of maturity in a company's journey. It's also a sign of maturity in a country's financial market, and it's a sign of a maturing investment community. These are 3 points highly relevant to the emerging investment scene in Myanmar. To elaborate, a public listing says a company has achieved a certain standard. It is credible and safe for the general public to invest in a business. Having a vibrant stock market with many companies listed shows that an economy has arrived. And when added to the debt and bond market, it gives companies access to different channels of liquidity and capital. And a listing says to all of us in the private equity investors who've backed the company that we were right, that our investment in a business and nurturing it to a public listing was a smart decision. So we can pat ourselves on the back. We're still at an early stage of listing in Myanmar, but MPE&VCA and our members want to be part of the process to create a vibrant public market with many successful publicly listed businesses. We and our members are natural partners to work with, and we want to partner with the Yangon Stock Exchange and other members of the investment community to identify, grow, support, and encourage well-run Myanmar businesses to raise the capital they need here in Myanmar. Now, to discuss this more, and frankly, with much more authority than I'm able to, we are privileged to have an excellent resource, Julia Charlton. Julia has a legal career focusing on the listing of companies on stock exchanges, which spans over 38 years. And she's actively worked on the listing of securities on exchanges from London, Hong Kong, Singapore, Cayman, Bermuda, Vietnam, Australia, Moscow, Shanghai, and Shenzhen. And she's advised companies listed on many other exchanges worldwide. In addition to advising professionally on the listing of equity, debt funds, and derivatives, Julia served for 6 years as a member of the listing committee on the Hong Kong Stock Exchange and has served for over 12 years on the takeover panel of the Hong Kong SFC. Amongst other deals that Julia's worked on, she worked on the listing of AIA on the Hong Kong Exchange and continues to advise UC Rusal, the world's largest aluminium company, which is listed on the Hong Kong Exchange. She worked for over 2 years advising on what remains Asia's largest successful debt restructuring on the listed debt and equity of a group of Hong Kong exchange-listed companies owned by the Guangdong provincial government. So I can't think of anyone who has as much experience as Julia. Her knowledge is extraordinary, and she's also now an acknowledged expert on fintech and blockchain. Julia is an old friend of Myanmar and has been coming here for many years, setting up an office in 2012. She's going to cover listing options from Yangon to London to Singapore to Hong Kong, strengths and weaknesses. So over to Julia.
Thank you, Josephine, for your very kind introduction. Well, good morning, ladies and gentlemen. I'm Julia Charlton, and as you've heard, I've been a lawyer for a long time. And from the first day that I started work as a corporate finance lawyer in London, in fact, a trainee solicitor in 1982, I was captivated by the listing rules. You might find this hilarious, and many do, but it's been my good fortune because I've incredibly enjoyed my life as a lawyer. I've spent a lot of time looking at the listing rules and being involved in the big policy debates and issues of the day. Recently, I've also been involved in crypto and the legal aspects of crypto exchanges, of which Hong Kong has around 25 and Singapore has around 20. I've participated in shaping some of the public policy debates which have raged in the Hong Kong market for many years, including, for example, the debate about weighted voting rights. These, as you may know, are the additional voting rights which some founders, particularly of tech companies, like to retain so that they can keep control of a company while still attracting more equity capital. This is always a controversial issue, especially when I'm talking to private equity and venture capital fund managers. So it's against this background of a lifetime of working in stock markets and listings from a legal point of view in London, Hong Kong, and as Hong Kong is such an international place, also in a number of other overseas exchanges, that I look with great enthusiasm on the potential development of listings of Myanmar companies. Indeed, that's why I was first moved to establish our office in Yangon in late 2012, because I was optimistic about the future of Myanmar companies' growing capital needs and over time listing on stock exchanges both inside and outside of Myanmar. And I'm very much looking forward to the next few years when I hope to see Myanmar companies and their listing activities grow considerably. I've been involved acting for investment banks, for sponsors and companies when listing, as well as major shareholders on very large listings and private equity funds seeking IPO exits. I've also been involved with companies which we've advised from absolutely a blank piece of paper and a complete greenfield investment, which have gone on to grow to become listed companies in their own right, listed in some cases on the London, Hong Kong, Shanghai, or New York exchanges. Planning a future listing can be a useful discipline, encouraging even small companies to think about corporate governance and the environmental and social governance and diversity requirements, which may now be increasingly a factor which investors may look for in listed companies. And all of these can be very positive factors on a company's growth journey, as well as the raising of capital on the IPO. When considering exchanges, I think it's interesting that the growth models of exchanges have fallen broadly into three trajectories, based on organic, state-driven and hybrid models, with some models evolving between these categories over time. Organic growth was seen in the US, London and Hong Kong exchanges. These were often founded as private enterprises. In many cases, there were competing exchanges in the same market. In Hong Kong, 4 of these exchanges were merged in the 80s to form the current Hong Kong Stock Exchange. And in New York, the New York Exchange, NASDAQ and some smaller boards continue to this day. The state-driven model was seen in China and also in Vietnam, where the exchanges were government-owned, and in the early days, a number of large state-backed SOEs, which are unlikely to fail, were listed to achieve a critical mass of investable securities, as well as to raise capital for the state sector. Thirdly, there's a hybrid model involving a mix of state involvement and market forces, which is the model China seems to be adopting at the moment. So today I'm talking about the possible listing venues for Myanmar companies, also touching on the opportunities for listing bonds issued by Myanmar companies and listing funds. Firstly, we'll look at the Yangon Stock Exchange, which, while it's been making strides, remains in its infancy, offering limited liquidity and low valuations. In view of these considerations, I'm also looking at the possible alternative listing venues for Myanmar companies such as Hong Kong's GEM, Singapore's Catalyst Board, and London's Alternative Investment Market, or AIM. I'll also be looking at the younger markets of Thailand and Vietnam. I won't be covering the mainland China markets in Shanghai and Shenzhen and the Star Board, as up to now these haven't allowed the listing of overseas companies, partly possibly because of the difficulty in the convertibility of the RMB. In future, however, they may, and as may the planned Macau Stock Exchange yet to be established. So before delving into each possible listing venue, I've compiled some data as at the end of last year on the relevant exchanges in terms of, as I see them, of course, in terms of IPOs, funds raised, number of listed companies, and market cap. As you can see, Hong Kong is a standout player in Asia, ranking first globally in terms of IPO of funds raised in 2019. It offers two markets for listing, the main board and GEM, which has lower admission criteria. And Hong Kong over time has actually become primarily a market for listing mainland Chinese businesses. Singapore also has two boards, the main board and the catalyst, and several Myanmar companies have listed in Singapore using Singapore listing vehicles. The SGX is a much smaller market for equity listings than Hong Kong, and this has been exacerbated by increasing numbers of delistings generally, due in part to low liquidity and valuations. Singapore, however, has a strong debt market and with over 3,000 listed debt securities representing a total of over $1 trillion in issuers from 45 countries. London's main market has three segments, premium, standard and high growth, each tailored to different capital raising requirements, with a combined market cap of $3.9 trillion at the end of last year. AIM is a sub-market of the London Stock Exchange, catering for small and high growth companies. And since its launch in 1995, it's become one of the world's most successful growth markets, thanks to its simplified regulatory regime designed for small and emerging companies. There were 830 companies listed on AIM as of June, and the daily trading volume for AIM companies averaged £2.4 billion in 2019. In relation to Thailand and Vietnam, Thailand is Southeast Asia's second largest economy and has two boards, the SET, the main board, on which bigger companies trade, and the Market for Alternative Investment, MAI, which lists small and medium-sized enterprises. Thailand does have long-term growth potential, but the stock market is predominantly comprised of old economy stocks, so not so many technology stocks, which benefit, of course, from the current work from home and at-home entertainment booms. Vietnam has two major exchanges, the Ho Chi Minh and the Hanoi, and a third market, the unlisted public companies market, which has lower disclosure requirements and is aimed at encouraging private companies to publicly trade their shares with a view to going public in the future. There are reports that Vietnam is likely to be upgraded on the MSCI from frontier market to emerging market status, with this expected to attract further foreign capital to the market. So I'll go into a little more detail about each listing venue and the opportunities for Myanmar companies to list. So turning to Myanmar and the Yangon Exchange. To date, there are 6 companies listed, which you can see on this slide, and the market cap as of last month was $490 million. Firstly, there's FMI, Myanmar Tilawa, Myanmar Citizens Bank, First Private Bank, TMH Telecom, Everflow River Group. Other companies reportedly considering listing this year are Myanmar Agro Exchange Public Company, Myanmar Agribusiness, and Great Hall Kham Public Company. It would seem that the current limited interest in listing on the YSX may include concerns surrounding the impact of enhanced scrutiny and increased transparency, including potential tax liability, concerns over loss of control, and the need for greater familiarity with corporate governance requirements for listed companies. Also, I would mention that liquidity is a problem, with companies being relatively perhaps reluctant to list in the near term. On that note, let's take a brief look at the requirements for listing on the Yangon Stock Exchange. So a company has to be a registered public company limited by shares under the Myanmar Company Law or one of its predecessors. Additionally, a number of track record and financial tests have to be met, which you can see briefly outlined on this slide. It has to be profitable for 2 years prior to the date of the listing application, have paid up capital of over 500 million Myanmar kyats on the date of the listing application, and have conducted business for a continuous period of at least 2 years prior to listing. A newly listed company must have a minimum of 100 shareholders at listing and a public float of at least 5,000 shares on the listing date, and an expected market cap of the public float at listing of 500 million Myanmar kyats. Other requirements you can also see outlined on the screen include compliance with Myanmar financial reporting standards, no restriction on the transfer of a company's shares, shareholder services must be entrusted to YSX as the shareholder services agency, shares have to be transferred through the book entry transfer service provided by YSX. As for the listing process, it typically takes around 18 months, involving preliminary preparations, appointing external advisors, developing a financial and business plan, and perhaps reviewing and restructuring the current ownership structure if necessary. Further preparations, such as finalizing historical financials, DD, drafting the prospectus, etc. Final preparations, finalizing DD, completing the prospectus, listing document, and listing application. And from there, once all listing application documents are submitted to the YSX, it typically takes around 7 weeks, or in practice perhaps longer. On approval, the YSX will make a website announcement, and the prospectus must then be lodged with the SEC for approval to offer the shares. The issued shares will then be converted for electronic recording as part of the offering process and listed. I would also stress the need for good investment communication and PR during this process of share offering and once listed. A significant development, however, was notification number 1 2020 issued by the SECM, permitting foreigners to trade Yangon listed stocks, a move aimed at scaling up the Yangon stock market, increasing liquidity, and enabling businesses to access capital to fund their expansion. However, we have to be mindful that under the company's law, a restriction remains on the maximum total foreign stake that may be held in a Myanmar company traded on the YSX, currently 35%. However, Myanmar's growth potential is expected to generate foreign investor interest in Yangon listed stocks. As one of the newest exchanges in Asia, the YSX is still, therefore, in its early stages and is in the process of catching up with other regional exchanges. This isn't to say, however, that the advantages of investing in YSX listed stocks don't exist. For example, low pricing, and it would seem that the YSX is likely to become an increasingly attractive listing option for Myanmar companies, particularly if it experiences growth like that seen in the Vietnamese markets, which saw the aggregate market cap of Vietnam's top 10 listed companies rise 16% year on year to almost $88 billion in 2019. It's also significant to touch on the proposal from late last year to establish the Myanmar Public Companies Board in order to enable the public, including foreign investors, to trade shares of companies not listed on the YSX, with the expectation at the time that the board will be operating by the fourth quarter of this year. The proposal for the Public Companies Board comes in an effort to support the YSX, which sees low daily trading volumes, as I've mentioned. And further to this, as also mentioned, many companies still struggle to fulfill the listing criteria. So the creation of an alternative trading market with less restrictive trading rules should therefore provide in the short term an alternative route for Myanmar companies looking to access public capital, and in the long term aid companies looking to eventually list on the YSX within a time frame of, say, around 5 years. Not to mention the fact that an alternative trading market will foster growth of the Myanmar capital market, hopefully, and allow for greater liquidity generally. Apparently, there is around 250 potential candidate companies that could join the Myanmar Companies Board. And the inclusion of foreigners is particularly significant. It was not until 6th of March that the SECM allowed trading by resident and non-resident foreigners, in addition to allowing securities companies to receive applications from foreigners for account openings under the Foreign Exchange Management Regulations. So allowing foreigners to trade from day one is an important step, highlighting the Myanmar government's intention to attract more foreign investment, which should be beneficial to local businesses. The success of alternative trading markets in other jurisdictions is an indication of the potential of this proposal. For example, the UK-based AIM, Singapore Catalyst, and the first alternative investment market in Southeast Asia, and Vietnam's unlisted public company market, which has around 833 traded firms and a market cap of around 45 billion US. I'll also briefly mention Myanmar's bond market and its development. It's very much in its early stages, with issuance limited to government securities, but regulatory developments are expected to pave the way for corporate bond issues, and corporate debt securities are included in the capital market development plan for the Myanmar market. Meanwhile, the SECM is also seeking to create a secondary market for debt securities on the YSX, and is currently looking at best regulatory practices for corporate bond issues. So in view of the planned developments which are still being worked on in the Myanmar market, I'll now consider some of the alternative options for listing, briefly reviewing the listing requirements and the possible advantages of each venue. So the Hong Kong Exchange allows full access to foreign investors wishing to trade on its markets, providing listed companies with access to a diverse and global investor base, which includes mainland China investors for some stocks through Stock Connect. The Hong Kong Exchange further offers a listing venue for foreign companies on either of its two boards, the main board and GEM, which accommodate IPOs of a range of sizes. Key advantages of Hong Kong as a listing venue include its established legal system based on English common law. It has a good, transparent regulatory regime for listing, relatively strong corporate governance standards, which gives investors some confidence in the Hong Kong market. It offers some tax advantages, currency convertibility, free transferability of securities, and no restrictions on capital flow. The abundance of international investment banks, law firms, and accountancy firms is also thought to facilitate company listings. Hong Kong also offers foreign companies the chance to raise their profile and visibility in Greater China and the rest of the Asia-Pacific region. However, in recent years, Hong Kong has seen an increasing number, mainly of mainland Chinese businesses listing in Hong Kong. There were 2,449 companies listed on the Hong Kong Exchange at the end of last year, of which only 218 were incorporated in Hong Kong. Over half the companies are incorporated in Cayman, which is followed by Bermuda, all usually holding mainland Chinese businesses and assets, and then China. A key factor attracting companies to the Hong Kong market is the depth of liquidity in both its primary and secondary markets. The listing requirements are rather onerous, and from the perspective of Myanmar companies, there are additional challenges. In order to list on the exchange, a company has to be incorporated in one of 4 recognized jurisdictions: Hong Kong, China, Bermuda, or the Cayman Islands, or in one of 27 acceptable jurisdictions, or be deemed acceptable by the Hong Kong regulators. As Myanmar is currently not deemed to be an acceptable jurisdiction, and it's not likely to be classified as one, as Myanmar is not yet a signatory to the IOSCO MMOU, and the SECM has not entered into any bilateral agreement with the Hong Kong SFC. A Myanmar company seeking to list on the exchange would have to restructure under a company incorporated in one of the recognized jurisdictions, such as Cayman, which would become the listing vehicle. Even then, questions may be raised about the suitability of a business based in Myanmar, and the exchange and the SFC would need to be consulted in advance of any application being made. The requirements, you can see them outlined on this slide, covering suitability requirements, financial track record, public float, shareholder spread. There's a lot of them. And a distinctive aspect of Hong Kong's listing regime is also the requirement to appoint one or more investment banks as sponsors to deal with the Hong Kong Stock Exchange on the listing application. And they are required to carry out due diligence to very high levels. And this is a rather onerous requirement, and ultimately listing in Hong Kong is a relatively expensive and time-consuming process, which is probably most worthwhile for companies who are raising a lot of money. It's also worth noting that Hong Kong, like many other jurisdictions, has tightened the rules governing reverse takeovers due to perceptions that they were being used to circumvent the requirements for new listings, and the concerns that certain companies were listing on GEM not as a means to raise capital for a genuine business, but rather as a shell company intending to profit from the status as a listed company and be a vehicle for a reverse takeover. And this was mainly driven by the demand for shell companies by mainland companies. In practice, it's also highly unlikely that a Myanmar company seeking to list on the exchange through a reverse takeover without it being treated as a new listing application, which would mean that the challenges I just mentioned in relation to conventional listing would largely remain, even if a reverse takeover could be achieved. Listing debt in Hong Kong, there are 2 main ways: debt securities offered to public investors in a retail offering, and those offered to professional investors. The vast majority of debt securities listed on the Hong Kong Exchange are professionals-only issues due to the simplified regime for professional-only debt securities. Key advantages of this route are the shorter time frame and the simplified disclosure. And a major current focus of the Hong Kong Exchange, which I think we'll see more elsewhere in Asia, is to encourage the issuance of green bonds. Listing closed-ended funds on the Hong Kong Exchange, for example, a closed-end Myanmar fund, is in practice such a difficult process for all closed-end funds that it's rarely done these days. The Singapore Exchange. Singapore has a strong international representation, with around 40% of listed companies' businesses originating from outside of Singapore. In terms of jurisdiction of incorporation, as at March this year, there were 465 Singapore companies, 84 China companies, and 167 overseas, excluding China companies, listed on the SGX. Of these, a number are Myanmar businesses, with listing vehicles incorporated in Singapore. Some examples include Yoma, Singapore Myanmar Investco, Interra Resources and Memories Group, which listed via reverse takeover in January 2018. In fact, we've seen Myanmar companies generally list on the SGX via reverse takeover. Uncertainties therefore mean that the major shareholders of Singapore-listed companies may be less willing to enter into reverse takeover deals with Myanmar businesses, but it's still theoretically possible. The SGX, like Hong Kong, has tightened the requirements for listings by reverse takeovers, with the listing rules amended back in 2012 to say that the SGX normally applies the same criteria in assessing reverse takeovers as it does to the assessment of IPOs. Singapore is ranked as the world's most competitive economy by the World Economic Forum, and a major advantage for growing businesses is that to list on Catalyst, there's no minimum track record period, market cap or other quantitative listing criteria, and expenses associated with listing are generally lower than on global stock exchanges such as Hong Kong. Issuers must, however, ensure that their articles or other constituent documents meet the requirements of the SGX listing rules, and for non-Singapore issuers generally, it's also important to note that they're required to announce any change in the law of their home jurisdiction, which could affect shareholder rights or obligations. When considering Singapore in the context of the listing of Myanmar companies, I think it's important to consider that beyond the overall size and liquidity of a particular exchange, arguably the more important consideration is the size, analyst coverage, and liquidity of the relevant sector or region that the company falls under within the companies listed on that stock exchange. So if a critical mass of Myanmar companies listed on the Singapore Stock Exchange can be built up based on the current Myanmar listings there, this may create the preferred overseas exchange for Myanmar companies to list going forward. As already mentioned, Singapore has a significant bond market, and bonds issued by Singapore or overseas companies, supranationals, government bodies, or any other entities, whether established in Singapore or elsewhere, can be listed on the main board of the SGX. Turning now to London's AIM. This has a key advantage as well, being that there are no restrictions on where a company is incorporated, with a company eligible to list, provided it is properly incorporated under the laws of its place of incorporation, and its shares can be offered to the public. A Myanmar company incorporated in Myanmar can therefore list on AIM, but in practice, as with listing in other jurisdictions, the company may wish to restructure for other reasons, such as the preference of investors or tax. Currently, there's one Myanmar-based company listed on AIM, the Myanmar Investments International Limited, which raised around $6 million US. The company's investment portfolio includes AP Towers, one of the country's largest telecom towers companies, and manages a significant proportion of Myanmar's telecom towers. AIM is suitable for emerging companies of different sectors that would like to access the UK capital markets for growth, and which don't meet the listing requirements of the main market of the London Exchange. The industry sectors of AIM-listed companies are broad and include financial services, tech, and mining. In terms of advantages, listing on the AIM market would not only give companies access to raise further capital for growth, but would also broaden a Myanmar company's investor base with London institutional investors. The listing would also boost the company's profile, and publicly tradable shares can be more attractive to their staff in such an environment if the company has a stock option scheme as part of the salary and employee benefits package. For listing criteria, AIM is relatively less onerous and burdensome, and this could be attractive to and preferred by emerging companies. Comparing AIM to other growth markets such as Hong Kong's GEM, the criteria for listing in AIM are relatively low, with no specific profitability, minimum market cap revenue or cash flow requirements, but directors have to be able to show the company has enough working capital to meet its needs for at least the next 12 months. There's also no mandatory track record period. However, nomads, that's the investment bank taking care of the listing, typically expect candidates to have a record of sustained growth for at least 3 years. Forecasts showing sales continuing to grow and a record that compares favorably with their peers. Directors and senior management also have to be able to demonstrate that they have appropriate collective experience and expertise to run all aspects of the business and not have any conflicts of interest. Further, there aren't any continuous ownership or management requirements, no minimum market cap, save for an investment company which has to raise at least £6 million on listing or immediately prior to listing. There's no minimum number of shares to be held by the public and no minimum number of shareholders. In terms of what's required, AIM companies, as I mentioned, have to appoint a nominated advisor on Nomad, an investment bank, an accountancy firm, or even in some cases a law firm, which provides advice on the listing application process and complying with the AIM rules. And they have to retain the services for the duration of their listing. Nomads undertake due diligence to ensure the company is suitable for listing and have to confirm that the company is appropriate to be listed and that directors are capable of managing a listed company. A further requirement for AIM, unlike most exchanges, is the requirement for listed companies to maintain this broker at all times. For example, in Hong Kong, there's the requirement for sponsor, but you don't have to keep having the sponsor indefinitely. Of course, there are also due diligence requirements in order to identify the risks or issues that may affect the value of shares, suitability of the company for listing, or that require further disclosure to potential investors. But in reality, in my experience, the due diligence requirements are not as onerous as they would be to list in the Hong Kong market. It isn't possible to list debt securities on AIM, although they may be listed on the London Stock Exchange's main market and the professional securities market. Closed-ended funds can be listed on the specialist fund segment of the London Stock Exchange and can include funds listing in Myanmar. Vietnam. Well, Vietnam is a growing and emerging market, as we all know, and it's opening up to foreign investors. And as previously mentioned, these exchanges have seen tremendous growth, with Vietnam's VN index surging 48% in 2017. As of January this year, stock prices were, however, low compared to returns. As at June, there are 380 companies listed on the Ho Chi Minh Stock Exchange and 357 on the Hanoi Exchange, all of which are domestic companies. As you can see, Vietnam, from this slide, Vietnam had a stellar growth year in 2018 with a market cap of 3.1 billion US and a total of 4.6 billion US dollars raised, achieving top performers in Southeast Asia. This was mainly attributable to the government privatization of state-owned enterprises. This slowed in 2019, which led to significantly lower funds being raised for the year. But in the third quarter of 2019, the government issued a decision approving a list of 93 SOEs to be equitized by the end of this year. I'm not sure whether or not that will be met. As for the listing regime, it's not unduly onerous, with low financial eligibility requirements and relatively low listing costs. It's also worth noting that a new securities law, which was adopted in November last year, will come into effect in January 2021, which provides for one stock exchange in Vietnam, which may result in the restructuring and merger of the two exchanges. As for bonds, government bonds are listed in Hanoi, while corporate issuers may list their bonds on either exchange. But due to minimum paid-up capital requirements, larger companies generally list their bonds on the Ho Chi Minh City Stock Exchange. And the securities law stipulates the conditions for offering bonds to the public, and in addition, conditions for listing are set out in a government decree. Looking now at Thailand, it's one of the leading capital markets in the Southeast Asia region and the second largest economy in the region. And companies listed on the Thai exchange operate in a range of industries from fashion to transport and logistics. As of June, there were 724 companies listed on the Stock Exchange of Thailand. Currently, Thai incorporated and foreign companies can be listed on the Thai Stock Exchange. However, foreign companies are subject to a different listing regime from Thai incorporated companies. Myanmar companies, along with companies incorporated in Cambodia, Laos, and Vietnam, would be subject to a less stringent listing approval regime for foreign incorporated companies. The Thai Stock Exchange is expecting more companies from neighbouring countries to raise funds on the Stock Exchange of Thailand, in part through real estate investment trusts, with authorities aiming to expand investment alternatives for Thais and foreigners alike. Seemingly, the SET has approached owners of hotels, office buildings, shopping malls, and other properties in Laos, Cambodia, and Myanmar to tap the capital market for long-term funds. It was also noted that Myanmar has the highest potential for new issuers among neighbouring countries, owing to its relatively large population, pace of economic growth, and developing financial system, coupled with Thai investors looking for alternative investments. Key advantages which the Stock Exchange of Thailand says it has include potentially providing issuers with a more liquid market, with the Stock Exchange of Thailand having the top rank in terms of trading liquidity in ASEAN and visibility. The key listing requirements for listing on the Stock Exchange of Thailand and the MAI are briefly summarized. As you can see, the requirements for listing on the MAI being much more flexible than those of the Stock Exchange, with key differences including lower paid up capital, fewer consecutive years prior to qualifying for listing required, fewer minor shareholders required, and lower fees. The Stock Exchange of Thailand does, however, say that they apply the same criteria and regulations governing distribution of shares to each board. And as to any other listed firms and MAI listed companies, they have to meet the same criteria as those listed on the SET concerning public disclosure of information. So in the words of the SET, MAI listed and SET listed companies are of the same quality. In relation to bonds, debt instruments can be listed on the Bond Electronic Exchange, BEX, launched by the SET in 2003. 273 bond issues are currently listed with a total size of approximately 227 million US. Approval has to be received from the Thai SEC for bonds to be listed on the BEX, and both listed and non-listed companies can apply to list their debt securities. By way of quick comparison, I'll now briefly discuss India and Pakistan. India. Currently, companies are not allowed to directly list their equity. Foreign companies are not allowed to directly list their equity shares on the Indian stock exchanges. So these companies generally set up subsidiaries in India and get listed. And there are in fact around 150 Indian subsidiaries of foreign companies listed on the Bombay Stock Exchange, with a combined market cap of around 10% of the total market cap of all companies listed on the Bombay Exchange. Examples of multinational companies in India in which the foreign shareholding is over 50% and or the management control is vested in the foreign company include Colgate-Palmolive India, United Spirits, which is listed on both the National Stock Exchange and the Bombay Stock Exchange, and Nestle India. Following a report published in December 2018 by a committee constituted by the Indian SEC advocating for the overseas listing of Indian companies, which laid a blueprint for the legal changes necessary, there was a Companies Amendment Bill 2020 introduced on the 17th of March this year, which amongst a series of amendments to earlier Companies Acts includes provisions allowing Indian companies to list securities directly on overseas exchanges. Allowing listing on overseas exchanges marks a departure from the existing regime, since Indian companies can currently only access foreign capital markets by issuing depository receipts. Permitting Indian companies to list in this manner on overseas exchanges gives them access to a choice of jurisdictions from which capital can be raised, with varying costs of capital and listing conditions, and offers the benefit of increased visibility, grants access to investor bases with a greater understanding of an appetite for niche businesses. And the bill also creates the opportunity for Indian companies to list their shares on stock exchanges of various jurisdictions at the same time, allowing them to distribute home market risks. While there are different models through which companies achieve such multiple listings internationally, the Indian government appears to be considering cross-listing, where the same company lists in shares on multiple exchanges, perhaps something which Myanmar may look to for future developments down the road. The Pakistan Stock Exchange came into existence in January 2016 following the merging of the three exchange markets, the Karachi, Islamabad and Lahore. And in terms of performance, the PSX was not in an ideal state last year, with Bloomberg claiming that it was the world's worst, having erased half of their market value. There was, however, slight growth over the past fiscal year, and the benchmark KSE 100 share index was marginally up by around 2% in the 2019 financial year, with the index increasing by 18% during the fourth quarter last year. Foreign companies are allowed to list on the PSX, and in terms of investors, there's approximately 1,886 institutional investors and 883 domestic institutional investors, along with around 220,000 retail investors. So, ladies and gentlemen, that largely concludes my brief overview of listing options for Myanmar companies. Other listing venues, such as the Philippine Stock Exchange, the KL Stock Exchange, and the Australian Securities Exchange, are also examples of further exchanges which we could have been considering. Listing the depository receipts of Myanmar companies already listed on another exchange is also a future potential option. For Myanmar funds, there are also exchanges such as Luxembourg and Ireland where they could list, and I haven't had time to cover all these possibilities. But I think we should also reflect on the fact that the future of exchanges may be digital. And just as Myanmar's fintech sector is surging ahead, it's possible to envision a scenario in which an online digital exchange with trading through a mobile app, which could quickly emerge for trading in fiat currency of shares and settlements through one of Myanmar's thriving online payment systems. This could allow Myanmar to leapfrog the stage of growing a more physically based exchange based on existing models drawn from the pre-tech world. So please do raise questions or make any points you would like to discuss, and I'll do my best to answer.
Thank you very much, Julia. It gives a great overview about the exchanges and also for Myanmar companies to give a consideration for listing at those exchanges. So for the attendees, if you have any questions to ask, please feel free to type in the chat box, and we'll raise those questions to Julia. So before getting the questions from the attendees, there is a question from my side. The Yangon Stock Exchange is currently planning to have a pre-listing board, and it is currently studying other neighboring markets like Vietnam, as Julia explained, and also Thailand, which is the market for alternative investment, MAI. And however, they're still in a very early stage. On the other hand, Myanmar is also a handful of these private equity venture capital firms that have already made investment. So looking from the point of view of Myanmar companies, what is your take on the pros and cons of raising capital from a buyout firm and through a sub-market listing?
Wow, that's a really broad question. Thank you very much, Juliet. Well, raising capital from a buyout firm may be regarded as less onerous. There's, in terms of public financial disclosure isn't required, independent directors, ESG investing, but it really depends on the actual investor who's investing, what their own requirements may be. It may be less costly to raise capital from a single or one or more private equity investors. And of course, the owners are accountable to perhaps just a few investors who, if they're behaving well, would be extremely supportive to a business. In terms of listing on a market, well, that's a huge preparation process. It's public. It requires a lot of grooming of the board, the company, and getting it all up to a very good standard to meet public listing requirements. Otherwise, the company is unlikely to be able to meet the requirements for listing and would expose potentially the company and its directors to lawsuits by investors who may lose money if there's misleading disclosure, etc., in a prospectus. It may be a good thing, however, because a company which lists can perhaps give share options, and it's helpful for it to attract talent. And of course, there's a wider investor base. There may be a perception amongst founders that it's easier to deal with an amorphous mass of shareholders than deal with one or two very engaged financial investors. There's also the benefits the enhanced corporate governance would bring, because the company would be under a lot of scrutiny, otherwise it would not perform in the market. So that's a great discipline. And of course, but if a company lists, then of course investor communication, both at the time of listing and thereafter, is very, very important for it to be successful. And that doesn't apply to the same extent at all where there's some financial investors. But having said all of that, I would say that my answer really would be that I would say both, actually. And some of the most successful cases I've seen of growth amongst my clients have been where there's been private equity investment or other forms of investment for a period of between, so anything between 1 to 5 years in a business to support the business and bring professional management, professionalize and change the mindset of founders. And the existence of this type of professional investor, financial investor, may well enhance a listing, because when a company eventually goes for listing, the public, generally shareholders, will look at the fact that this company has got a committed backing from, or has had, even if there is some exit of a financial investor, to actually support the listing. So I don't necessarily see these as either or. I think that in the best case scenarios, they're highly symbiotic scenarios.
Thank you, Julia. Also, another question to ask is about your comment. Can you please give a comment on the role of a good PE firm in achieving a successful listing? According to your experience, do they make it easier, to be listed on an exchange if investment comes from a PE firm?
The key there is a good one, right? Because I've seen, let me just talk about the less good ones. I've seen cases where, with North American investment into businesses, where there are private equity terms that they invest in generally tend to be quite harsh, because they're really just putting all their capital on the line. They tend to try to get the best possible terms they can, and companies, shareholders often don't have a huge amount of negotiating power at that stage. So there may be provisions in agreements which say that there can only be an exit if certain benchmarks are met. And sometimes those do not reflect the fact that markets may change dramatically. So what might have been a relatively reasonable benchmark of a financial target at the time the investment was made may not be 3 years later, but the company may still be doing very well. But I've seen private equity investors actually stop a company going for listing because it would have forced them to mark to market at a price which they did not want to put in their books, because it couldn't list at the benchmark price which was in the original documentation. So I think that that's on the more negative side, and that some not so good ones can be give management and shell so much pressure that they don't find it useful. But let's put that to one side, and that's certainly nobody who I work with. And at its best, I've seen some extremely wonderful outcomes of really win-win situations of private equity firms who've gone in, they've helped companies to grow, they've been there as a sounding board, they've helped them to put their ESG in place, their corporate governance, they've helped them to deal with their internal controls they will need to sort out for a listing, and they've been highly useful in helping the company to select the correct professionals to use for the listing process. And also, regulators take comfort from the fact when they see that there is a recognizable private equity fund which knows what it's doing, which is already an investor in the company. So in those situations, which I hope are the vast majority, and certainly many I've seen, those have been extremely win-win situations. But Josephine, I don't know if you have any comments on this. You've been a pre-IPO private equity investor that's done some fantastic work for companies you've invested in.
I'm obviously biased. I think that a good private equity investor shares the pain on a listing. And I've always said that when a company starts a listing, it is perhaps the most difficult thing that they're ever going to do. And so having someone who shared the pain before, and that's probably why my hair is so grey, means that it is a slightly easier thing than if you were trying to do it by yourself.
Thank you, Julia.
Thanks. I think Josephine's being actually quite modest, and I've in the Hong Kong market many years ago, I saw her and her team at that time do some highly successful supporting of companies on exit. So that's definitely possible.
Yeah, so there are a few of the questions. Just one question from Gray Jaw comes in, and just can you give a brief comment on your thoughts about the alternative trading market for YSX? So just to comment a little bit about your knowledge on this alternative trading market. Will they list foreign companies or shares?
I haven't seen the detail of this market, as my understanding is I don't think it's targeted at foreign companies. I think it's targeted more at Myanmar companies, but will allow foreign investors and domestic investors and so my view of it is it's extremely positive development, because if it encourages companies to go through the discipline of a listing, albeit not on the main board, then this would be a very positive. It would mean that Myanmar companies would have a stepping stone to perhaps a bigger listing and raising more money at a future stage, but perhaps being able to comply with requirements which are suitable for a company at its stage of development. So I see the development as extremely positive.
Sure, of course, yes. And also, question from Yuichi from Nikkei. What is your prospect for the establishment of a bond security market at the Yangon Stock Exchange?
Well, I think that there is some listing of sovereign debt at the moment. The prospect of it, I don't know where it's part of the Myanmar capital development plan, I think. I haven't seen an exact blueprint for when this might be introduced, but I can see that it would be useful to be able to list corporate bonds. Certainly, corporate bond markets in China have been extremely active, and they've been an extremely useful way. And quite a lot of regional and even city governments in China have issued debt which is tradable. So, I would see that as a very healthy development if that was possible to get off the ground.
And also another question from Sidhu Pyo from one of our member firms, Young Capital Partners, comes at he said he has heard that a few of the Myanmar companies had failed to list on the SGX through reverse takeover. So what do you think are the challenges? So if the listing through reverse takeover is feasible, what is the legal requirement for the original stake shareholders, who are Myanmar citizens, to own shares of the listed company on SGX?
Right. Well, I think, there's been successful and unsuccessful ones. And, one of the high profile unsuccessful reverse takeovers involved an issue with a shareholder who was involved with sanctions. So perhaps we put that to one side. I think that regulators generally, the SGX to a less draconian extent than the Hong Kong exchange, does really not encourage reverse takeovers, backdoor listings, because they see them as a way in which businesses don't receive the full scrutiny of the regulatory process, and they generally don't regard that as good for the market, because they're trying to aim at investor protection as well as capital raising, because in the long term, anything which doesn't involve high standards of disclosure and relatively transparent performance is not generally good for the market as a whole. So, as I mentioned, the Singapore Exchange has a general policy, as I understand it, and I'm not a Singapore lawyer, that they apply the same standards for reverse takeovers as they do to sort of front door listings. I think there's always challenges in a country with a jurisdiction which is relatively emerging, in terms of certainty, in terms of the due diligence, in terms of the legal opinions which can be obtained. So I think there's some sort of softer issues sometimes to do with the decisions that may be made by the Singapore Exchange. You can see that the well-known and large and well-performing companies, for example, Yoma Memories, that they did manage to list by this route and were welcomed in Singapore and are actively traded. The question about Myanmar individuals holding shares, clearly, that they would have to have Myanmar, they'd probably have to hold them through Singapore bank accounts and so on, or have nominees holding them. And I think there's a lot of grey issues in that area at the moment.
Question from Chi Chong is about the timeline to get to the listing point. So specifically, he said, what has been the experience from clients on how long it takes to prepare internally to begin to consider a listing? And from the internal board decision taken to seeking a listing and through to the actual listing. So generally how long it usually takes.
Right. I think it really depends on what the stage of development of the company is, because if a company is well run, has private equity investment, has, produces audited accounts, possibly by a big four or second tier audit firm, has internal controls in place, then the whole process should take, I would say, generally 6 months to a year. for a company which is really starting to think about listing, it could take anything from 2 to 5 years, I would say. And it's interesting that in the early days of the China market, they actually made a mandatory period of 2 years, a sort of monitoring period when companies had to begin to comply with the requirements of listing as a sort of test period up to listing. So I think, 2 years is probably the minimum, even before the application is made, if the company hasn't thought about it before. So I'm hoping that the new alternative board in Myanmar may provide to some extent a sort of a stepping stone, a halfway house for companies to come onto that and fully prepare for a more higher level listing.
Thank you. Well, a couple of questions from Mu Hain. Question about AIM. So nomads still have appetite for Myanmar companies. We're asking whether it still has appetite for Myanmar companies, given the past troubles he mentioned with Myanmar-focused firms on being listed on AIM and current political image of the country from the West lawmakers.
Geopolitics is kind of above my pay grade, but one of my Chinese clients said to me yesterday something really interesting. They said, capital doesn't care. That's a very general statement, and in the modern world we'd say capital cares a lot. But I think if there's good Myanmar businesses, I think with good cash flow and so on, not involved with any problematic parties, I do not see that as a bar to listing.
And also, he said, normally it's quite common for natural resources, related companies to go on AIM, but it has been the case with it has not been the case with such companies in Myanmar resources industry. And what do you think is that? Why is it that?
That's an interesting question, because I've done quite a lot of natural resources work myself, and I've often wondered the same thing. I think some of the larger acquisitions by foreign companies are actually under existing listed groups, which are probably already listed elsewhere. So it would be more likely to be it would be likely to be a overseas investor who'd got mining rights over a junior company that might consider listing. And if they could get all of the legal opinions, all of the mineral rights, etc., in order, there's no reason why they couldn't list on AIM. It would be a question of communication and the legal requirements, I think. And also, the mineral sector generally has been in a prolonged downturn since about 2010, 2011. So it's not unique to Myanmar that it's difficult to list and raise money in the mineral sector. I mean, it's generally very difficult worldwide. So I don't see any real difficulty. And I do think if a large group that was a producing mineral company with all of its legal opinions, all of its use rights, etc., all properly documented and held, then I would have thought there would be interest in that. There might be some discount for perceptions of political risk, but I do think that there would be interest from the sector of investors who invest in mining, because many mines and mining assets are not in first world economies. They don't tend to be. The most interesting assets are actually located in other places. So it should be eminently possible to list them.
And also, Wu Heng also raised another question about, with the risk of aggressive policy changes always there by the Western government, should London Stock Exchange still be considered by the Myanmar companies? Your take?
Again, geopolitics is above my pay grade. But as I understand it, the statement of the UK government was very clear that they do support the current government in Myanmar, and the UK is extremely positive towards Myanmar at a governmental level and also at a general level. Aside from some sort of politically motivated moves that they perhaps feel they have to make, they're relatively limited. They certainly don't even apply to the companies involving the individuals concerned. So I don't see this as a major issue.
Sure, thanks. So before we wrap up, there's one more question that we want to give it to you. Actually, it's an advice. How can Yangon Stock Exchange gain momentum if companies from Myanmar continues to list on other regional stock exchanges? What do you think Yangon Stock Exchange's progress so far, and what's your thought on how they should be addressing?
I think they could consider a number of ways, and there's no one size fits all. And, the fact that we already have an exchange in Yangon and so on is already a huge achievement. I think that they could choose between the models I was talking about, the state-driven model where a number of state-owned businesses of high quality list, which creates you need a critical mass to get into achieve a following of investors, to achieve liquidity, to achieve all the infrastructure that goes around markets, the trading, the analysts, and so on. So that's one model, which was the China model, and to some extent the Vietnam model in the early days. Or there's the, let 1,000 flowers bloom model, which is just allow, lower your requirements, allow a lot of companies to list. And I sort of detect that in the new alternative board that's being set up, that's perhaps a look at that. Let's just let these companies develop, and let's see what comes out of that, so that we can achieve out of that the best companies will come forward to the main board. So I think it's really deciding on which of these models is going to be used. It's also investor education within Myanmar. And as I mentioned as well, perhaps the future of that is actually allowing Myanmar people to buy shares over trading apps, pay through it through fintech and so on. We don't always have to look to the historic models. There's actually a burden of those legacy models that Myanmar doesn't have at the moment. So I think Myanmar Exchange, the Yangon Exchange, has a bright future. It could adopt any of these models.
Thank you, Julia. I'm hoping for the best as well. I think it's time to wrap up. And thank you all for the attendees for attending. And thank you to our speaker, Julia Charlton from Charlton's. If you have any further questions or inquiries, please contact Julia at charltonsmyanmar.com or to us at MPE&VCA.org. We have another event, online panel discussion coming up on the 16th of July. Please register. It will be talking about the path to mass e-payment adoption for telcos. Thank you very much, and see you at our next webinar. Have a great day.
Thank you very much, Julia. Thank you very much, Juliet. Good session.